some organizations or some businesses, due to some reasons or due to challenges, would normally not keep records in adherence to the principle of double entries or the bookkeeping procedures. And these sort of organizations keep their records scantily or in any way they deem it fit. In accounting, we refer to such records as single entry records or incomplete records. So in this class, we'll be looking at single entry and incomplete records. Single entry is a form of recording the activities of a business in which the principle of double entry and other principles and procedures of accounting or bookkeeping is ignored. The point I'm trying to make is as a business, rather than keep records, the way it should be, it's possible for the owners of the business to adopt their own method that in most cases are not in adherence with the principle of double entry. Some businesses, you see them just use maybe an exercise book to record sales and then to record payments. And that's all you see them have all through a particular business or reporting period. Now, such an organization or such a business is deemed or referred to as a business using the single entry form of recording. And because they are not flowing or agreeing with the bookkeeping procedures in their method of keeping book, we say they have an incomplete record. So basically, any business that records its transactions or records its activities without adhering to the principle of double entry is using a single entry bookkeeping. And because of that approach, we say their records are incomplete. Now, what type of organizations do you normally see, or would you normally say, uses the single entry system? So basically, you see more of single entry system or incomplete record systems, in a petty traders approach of recording, and then you also see them in some small and medium-sized organization. Usually they see the cost of keeping a professional as a burden. They believe that they can always do it on their own. So they feel that the cost of hiring a professional to help them keep their records will make the business to spend more. So most of these organizations look at it that way, and as such will always want to adopt the single entry system of bookkeeping. Sometimes established organizations can as well fall into this category of businesses with incomplete records, but that would normally be due to some events. For instance, in recent times, it was reported that the office of the Accountant General of the Federation, was on fire. So that sort of scenario can render such an organization or such a unit or such an establishment or such a department, to have incomplete record. Now, I am not saying that the incident must necessarily result to having incomplete record, but it is possible for such an incident to result in the unit or the department having an incomplete record. So basically what I'm saying is that you find more of single entry system or incomplete record system with petty traders, with small size organizations and some medium size organizations. But established organization can fall into that category due to certain events that could make them lose significant part of their accounting information or reference documents. So here are some causes of incomplete records. What I'm saying is, what are the factors that can make a business to have incomplete records? The first one there is fire outbreak. I already gave an example that sometimes an organization, can have its office engulfed with what? Fire, and that can make the business lose vital information or documentary evidences or documentary references. So because of that, it is possible that they might not be able to recover the lost documents. So as such, it can render the business not to have complete record, and as such, we say the records are incomplete. The next one is theft or robbery. Sometimes you can have a robbery case where you have hoodlums attack a business office and then make away or do away with vital documents that is significant to the record keeping of the organization. Another point is the use of incompetent or inexperienced staff. When a business is using staff or employees that are not qualified to do the accounting job, most likely you have incomplete records or single entry system of bookkeeping. Hoarding. This is peculiar to some business owners that will intentionally not want to give information to those reporting the activities of their business. It could be for selfish reasons, or it could be a way of influencing records, to go in the direction that they want it to go. So sometimes you can have business owners hoard or hide information intentionally, to frustrate or to make the person reporting the activities, report the business in a particular way, especially when they are using incompetent staff that they can easily influence. Another point is system crash without backup. Sometimes in an accounting system where they use maybe softwares, or what they call maybe automated systems. So most times they have system crashing due to various reasons. It could be hacking, it could be any other reason. And then if there is no backup to restore the data of the organization, it is possible to render the business incomplete in terms of records. So basically, these are the possible causes, for a business to fall into the category of the single entry system of recording or the incomplete system of recording. Now we have established that the single entry system of recording or the incomplete system of recording is usually adopted by businesses. And this is not really a bad idea, especially for businesses that is just starting. But aside from that, because we already understand the fact that some businesses do not have the capacity to employ professionals due to the cost involved, so it is usually allowed for such businesses to find a way to record their transactions, and usually they use the single entry and incomplete records. On your own, you can just take a walk to some of all these maybe mini supermarkets or petty traders and ask them how they keep their records. They probably just bring out a notebook where they just write or scribble down some things and say that is how they make their records. But technically, we know that such approach is single entry and incomplete. But the idea is, even if you have to tell them to employ a professional, they might not have the capacity to pay. So even in agreeing to the fact that it is not an entirely bad approach, but we must say that the single entry and incomplete records system of keeping books or keeping record has some limitations, and these limitations are what we are going to be looking at. So here we have some limitations of single entry and incomplete record. The first one that we're saying, business owners are not properly guided on spends, hence resulting into capital bleeding. The point I'm trying to make here is that as the owner of the business who does not understand record keeping and accounting procedures, it is possible that they mistake sales for what? For profit. So as such, they keep spending, and it is possible that they might end up spending part of the capital that is meant to grow the business. Another point is the difficulty in understanding the entity concept. Basically, the entity concept is a principle of accounting that states that a business is different from the owners. You manage a business separately from the owner. So what the owner has as his cash is his cash, and what the business has as its cash is the business cash. So if the owner brings in money into the business, it becomes the business liability to the owner. But most of these owners might not be able to separate between what is theirs and what is the business's, and that is due to the fact that they do not keep proper records, and as such will not understand that there's a difference between themselves and the business. So the point is, if they had a professional to help them keep the records, the professional will be able to put transactions in perspective, and then from time to time train the owners to understand the entity concept. The next one is fraud being a commonplace in businesses with incomplete records. Because you do not keep proper record, you expose your business to fraudulent activities. The next one is loss of records, resulting into huge cost of record. The point I'm trying to make here is that for established organizations that can lose their record and then still recover it, in most cases, the cost of recovering lost data can be very, very huge, depending on where the backup is. So in order to avoid such, it is always advisable to avoid things that can result into incomplete records. The next one is the difficulty in explaining how to normalize a record to non-professionals. Now, as professional accountants, when we see businesses that have incomplete records, we have a process of normalizing it. Now, explaining that to someone who is not an accountant can be a huge challenge. Now, some businesses with incomplete records hardly review their bank statements. They just record sales and that's it. They hardly review their bank statements. So it is possible that the results of their record is usually overstated in terms of profit, because if you don't review your bank statement, you might not capture your bank charges, and once your bank charges are not captured, the profit report is overstated. Another point is the stress of raising journals. You have to classify transactions into their proper place because they are using incompetent employees. If you're using the wrong person for a particular job, you end up not having proper output. Okay, so accountants or professionals that handle incomplete records end up raising so many journals to reclassify transactions, and that is a limitation, to single entry and incomplete records. Statement of affairs, as a business that have incomplete records, what we do is we use whatever record we have to prepare the accounts, but there are procedures to help us achieve proper recording and reporting. So what we do here, we have what they call statement of affairs. Now, the statement of affairs shows the position of the business based on the records available. Usually, we refer to statement of affairs, in this essence, because the period is incomplete and the record, or the period can be complete, but the records are incomplete. So what we say is, what is the position of the business based on the records available? So instead of saying balance sheet, we say statement of affairs. When you use the word balance sheet or statement of financial position, you use that because the records are intact in terms of figures and in terms of period. But in this essence, or in this scenario of incomplete records, the records are not complete and you're having periods flowing into each other. So instead of using balance sheet, we use what? Statement of what? Affairs. That is a statement showing the position of the business based on the records available as at that particular period of what? Time. So it's like saying, okay, you're showing the assets of the business, you're showing the liabilities of the business based on the records what? Available. So that statement that shows is what we call statement of what? Affairs. Now, statement of affairs can be either at the start of the period or at the end of the period. Remember, we already established that statement of affairs is the statement that shows the position of the business based on the record available. Now, if the record available shows the position at the beginning of the period, the statement that shows the position of the business based on records at the beginning of the period is what we call statement of affairs at start. So it's like saying the statement that shows the assets and liabilities at start, and the asset at start and the liabilities at what? At start. So now we have established that the statement of affairs that starts, that has to do with statement that shows the position of business based on record available at the start of the business. But now we have statement of affairs at end. So that is the statement that shows the position of the business based on records available at the end of the period. So we can say a statement that shows the assets and liabilities based on records available at the end of the what? Period. So having established that there is statement of affairs at start and statement of affairs at end, so we can say that it is possible to determine the opening capital of the business. Okay, because we are dealing with a business with incomplete records, so we have to find a way around it. So first we know statement of affairs at start, and now we know statement of affairs at what? End. So that means we can tell the capital that the owner has brought into the business at the beginning of the period. So what we're saying here is that, in order to achieve, the capital that the business has at the beginning of the period, we use the statement of affairs at the beginning of the period, which is statement of affairs at what? Start. So since we know that the statement of affairs at start, shows what? Assets at start and liabilities at what? Start. Then the opening capital will be your what? Opening total assets minus opening total liabilities. That is the assets of the business at start minus liabilities of the business at what? Start. So we have opening total asset minus opening total liabilities. But liabilities have to be what? External parties. Remember I told you that a business has a liability to what? External parties, and a business has a liability to what? To the owner. So the business liability to the owner is what we call capital. Okay? So the business liability to what? To outsiders is what we call, liabilities to external parties. So what I'm saying here is that the opening capital of the business will be what? The total assets of the business minus the total liabilities of the business as at the beginning of the what? Period. So now, the determination of what? Of closing capital. We already established that opening capital is the comparison of your what? Total asset at start minus total liability at start. Now, the closing capital is the comparison of your total assets at end of the period minus total liabilities at the end of the what? Period. Liabilities to what? External parties. So basically, your closing capital has to do with manipulation of your what? Of your closing figures. Your opening capital has to do with manipulation of your what? Of your opening figures. Now, this is a question that will help us, determine closing capital and opening capital. So they say the following records we are gathered from the books of Dede, a sole trader. So we see there's 31st December 2009, 31st December 2010. So we have cash at bank, furniture and fittings, office equipment, debtors, creditors, cash at hand, bank overdraft, motor vehicle, inventory. This is for 2019 December. This is for 2010 December. They are now saying you're required to show the opening capital and closing capital as at 31st December 2010. Now remember, the end of a particular year is the beginning of the following year. So that means the end of 2009 is the beginning of 2010. So basically, the figures for the end of 2009 will be the opening figure of 2010. So let's show the opening capital. So we say this is day. Statement of affairs as at 31st December 2009. So what does it show? It shows your what? Assets and what? Liability. So basically, it's your balance sheet. But because figures are not complete, that's why we are calling it statement of what? Affairs. So the same way we prepare a balance sheet, that's the same way we prepare it. So we have our what? Furniture and fittings, non-current assets, 270,000 based on the question for 2009. Furniture and fittings, 270,000 2009. Office equipment, 250 for 2009. Motor vehicle, 450 for 2009. So that's all. Then current asset for 2009, cash at bank, 350. Okay. Debtors for 2009, 295. Cash at hand for 2009, 45,000. Inventory for 2009, 290,000. So if you add 350 plus 295 plus 45 plus 290 altogether, you have 980,000. So if you're adding 980 to 970, you have 1,950,000 for your what? Total what? Assets. Now, what are the liabilities in the question? 2009 liability here, we have creditors, and then we have what? Bank overdraft. So creditor is 125, bank overdraft is 175. So we have creditors 125, bank overdraft 175. So that's it for the liability. So if you add 175 to 125, you have 300,000. Okay? Now, what is the capital? I told you, capital is what? Total asset minus total liability. So, liability external. So, what do you have there? Opening capital. Owner's equity will be what? Total asset minus total liability external. So, what's opening capital? Opening total asset minus opening total liability external. So, what's the opening total asset? We have it here. 1,950,000. What's the liability? We have it here, 300,000. So 1,950,000 minus 300,000 give you what? 1,650,000. So that will be your opening what? Capital. So if you add it, you have your what? Your balance. So we are calling it opening capital because we are reporting 2010, and the end of 2019. So the end of 2009 is the beginning of 2010. So let's report the closing capital, which is the end of 2010. So we have statement of what? Affairs, 31st 2010. So we have the same thing. Furniture and fittings for 2010 is 260. You can see it here. Office equipment for 2010 is 230. Motor vehicle for 2010 is 400. So if you add 260, 230, 400, you have 800 and what? 90,000. So current asset, what's the cash at bank for 2010? Cash at bank, 550. Debt for 2010 is 350. Cash at hand 2010 is 50,000. Inventory 2010 is 135,000. So if you add 550, 350, 50, and 135, you have 1,085,000. So 1,085,000 plus 890, you have 1,975,000. So what are the liabilities for 2010? We have creditors, 130,000. We have bank overdrafts, 120,000. So if you add it to, you have 250,000. So basically, your total liability is 250,000. Your total asset is 1,975,000. So closing capital is closing total asset minus closing total liabilities external. So what's the closing total asset? 1,975,000. Total liability is 250,000. So if you minus, you have 1,725,000. So basically, that's your what? Closing capital. So you have your closing capital, which is owner's equity, to be total asset minus total liability, and that's what we have calculated here, which is 1,725,000. So we used the figures for 2009 ending to represent the opening figure of 2010. So that's how we got the opening capital. And then we use the figure of 2010 ending to get the closing capital of 2010. So that's how to determine your what? your opening capital and your closing capital. Now, we want to determine the profit or loss from our statement of affairs. Now, we have established how to get our closing capital and how to get our what? Opening capital. So, the difference between our closing capital and our opening capital is our profit or loss. If closing capital is greater than your opening capital, you have profit. If closing capital is less than your opening capital, you have what? Loss. So if closing capital here is 10, opening capital here is what? 8. Then that means profit is 2. If closing capital here is what? 8. Opening capital is what? 10. That means you have a loss of what? 2. So now we are using the same question, okay, that we just solved now. So from this question, we already know what the opening capital is, and we know what the closing capital is. We have already solved it. So based on this question, we already established that our opening capital here is what? 1,650,000. And our closing capital here is what? 1,725,000. So if you compare your closing capital 1,725,000 to your opening capital 1,650,000, you have what? Profit, because your closing capital is higher than your opening capital. So closing capital minus opening capital is equal to profit or loss. Okay. So here our closing capital is 1,725,000. Our opening capital is 1,650,000. So the profit is what? 75,000, because our closing capital is higher than our opening what? Capital. Now we already established how to what? Determine our opening capital, how to determine our closing capital, and how to determine our profit, comparing our opening capital to our closing capital. But now it's also possible that having established the opening capital and closing capital, and then having determined the profit, it's possible that the owner of the business would have taken some money for his personal use, or taking some goods for his personal use. We call it drawings. So in that scenario, the drawings will increase the what? Closing capital before you compare to your opening capital. So this is what I'm saying. In case you have drawings and you are asked to determine the profit or loss, then it will be closing capital plus drawings. Greater than opening capital is profit. Closing capital plus drawings less than opening capital is what? Loss. So what I'm saying is, if you have drawings, you increase the closing capital by the drawings before you compare to the opening capital to derive either profit or what? Loss. Now, using the same question, okay, we already know this. I know how to get our opening capital and how to get our closing capital. But we're not saying, okay, you are required to show the profit made for the year ended December 2010, assuming that they made withdrawal of 85,000 for his personal use. Now, this is 2009. So your furniture and fitting for 2009 is 270,000, 2010 is 260,000. Office equipment 250 for 2009, 2010 is 230. So you have all this. There's the same thing that we've done before. So we already established that our opening capital is 1,650,000 and our closing capital is 1,725,000. But they are not saying that we should determine the profit, assuming that that they withdrew 85,000. So what's the formula? Closing capital plus drawings minus opening capital. So what's the closing capital? 1,725,000 plus what's the drawings? 85,000 minus 1,650,000, which is the opening capital. So we have 160,000 naira as the profit. So based on this now, we know what the profit is, because we are comparing closing capital to opening capital, because there's drawings. I said you increase the closing capital by the drawing before you take out the opening capital. So closing capital plus drawing minus opening capital gives you the profit, and we've established that it is 160,000. So by the time we get it now, we can now redraft the balance sheet, because we are calling this statement of affairs because it is incomplete record. We are trying to establish or determine opening capital, closing capital, and then the profit. Now, having determined that, we can now prepare the balance sheet the way it ought to be. So here you have now day balance sheet as at 31st December 2010. So we have our furniture and fitting for 2010, 260,000. It's in the question. Okay, we have office equipment 230,000. We have motor vehicle 400,000. So 260, 230, 400 give us 890,000. We have our current asset, cash at bank 550,000 is in the question. We have debtors 350 is in the question for 2010. Cash at hand, we have 50,000. Inventory 135,000. They are all in the question. So if you add 550, 350, 50, 135, you have 1,085,000. So you add this to this, you have 1,975,000. So what are our liabilities from the question? Liability creditor here is what? 130,000. The next one is bank overdraft. Is in the question. Bank overdraft is 120,000. So we have 130, 120, that's 250,000. So the next one is now, remember how you prepare your balance sheet? Your owner's equity is a function of your what? Your capital plus your profit minus your drawings. So your capital here is 1,650,000, which is the opening capital based on the question. Okay? The opening capital based on the question. And then your profit is 160,000. So you add 160 to 165, you minus your drawings, 85,000, that gives you 1,725,000, which is your closing what? Capital. So if you add this to this, you have 1,975,000, which is your total liabilities, which is equal to your total what? Assets. In this class, we have been able to find a way to determine opening capital, closing capital, profit, and then prepare the revised balance sheet for a business with what? With incomplete record, or a single entry system of recording its transactions. Join me in the next class for us to prepare the detailed trading profit and loss account and balance sheet from incomplete record and single entry. Thank you.